Let's discuss all this with our first guest this morning, Charles St-Arnaud. He's chief economist with Alberta Central and a former economist at the Bank of Canada. And Charles, ahead of this decision, correct me if I'm wrong, I believe that you thought there was a reasonable chance that the Bank of Canada might cut interest rates next week based on encouraging trends on inflation. What's your reaction to these numbers this morning?
Well, I think generally the number this morning are in line with what I was expecting. I was expecting that, as the Bank of Canada has been saying, the last mile to bring inflation down to the 2% target will take longer and will be harder. And that's what we're seeing. We're still seeing a gradual easing in inflation. It kind of, again, the number this morning shows that the uptick we had in May was temporary. But we're seeing some progress, and I think it still supports the Bank of Canada cut next week.
And when it comes to some of the inflationary factors, coming into this report, I think people were expecting that you might see some encouraging trends on things like gas prices. On the flip side, people were wondering about so-called shelter inflation. And just looking at the June data, mortgage interest costs and rent remained the biggest contributors to the annual change of inflation. Just to remind our audience, higher interest rates have increased mortgage costs for Canadians, so there is mortgage inflation. And I guess people who have pushed back on the idea of that inflation being worrisome have said, but if the other trends are looking good and interest rates start to come down, that'll actually take some pressure off mortgage interest costs. So when you look at the components of inflation, what are you seeing right now?
Well, for me, I tend not to focus too much directly on the components per se. I agree the shelter cost has been a big reason for inflation to remain sticky. And I think, in my view, it's more a question of how it is affecting inflation expectations, because shelter is such a big component of household spending that it's probably the reason why we saw yesterday in the survey of consumer expectations that perceived inflation remains extremely high and sticky, and partly it's because of shelter costs continue to increase. But that component should start to ease in the coming months. We remember as all the rate hikes from last year kind of move away from the year-on-year comparison, you'll start to see year-on-year change in interest rates to be lower and actually contribute to ease inflation.
All right. And the gasoline consideration in June was an encouraging one, with price pressures easing there just as one of them. The other thing I think a lot of people have been wondering about is the various factors that play a role in bringing down inflation outside of the blunt tool that is interest rates. We just had a story about what's happening in the grocery sector, where there's been some evidence of consumers looking for better deals, looking for discounts, maybe thinking twice about buying what looks pricier, whether it's at the grocery store or at other locations. We saw some of the evidence of that show up in those Bank of Canada surveys yesterday. And so that's one consideration right now. I guess when it comes to what Canadians are doing in this higher interest rate environment, especially with the unemployment rate now more elevated, are those some of the contributing factors that you think will help to ease inflation burdens going forward?
Yeah, well, I think if we focus on inflation this morning, I think we're seeing that inflationary pressures to narrow. For example, the number of component of CPI that has been growing at more than 3% is now 30%. It was 35% in May. So you're seeing that breadth of inflationary pressure reducing. So that's something the Bank of Canada will be pleased to see. But yes, there's so many other components that are pointing to slow inflation, from bigger slack in the economy. We saw, again, yesterday in the Bank of Canada various surveys that inflation expectations are gradually, it's sticky, but it's gradually coming down. The fact that the unemployment rate has been rising, that growth in Canada generally has been relatively lackluster over the past few months, are all signs that we should continue to see further easing in inflationary pressure, and in my view should support the Bank of Canada to go ahead and cut again in July, and maybe take a longer pause and see how the economy reacts to that whole 50 basis point cut over the past 2 months.
I'm going to ask our control room if they can show our audience what's happening with the Canadian dollar at this hour. If there are inflation trends that are supportive of an interest rate cut, you might think that would be a consideration in the currency market. We are seeing some weakness for the loonie against the greenback right now, just below 73 cents. I should add that we had some solid retail sales in the U.S., which is another consideration when you're looking at the loonie versus the American currency. And a lot of people are wondering, given the resiliency of the U.S. economy, at what point you might actually see Fed rate cuts. And I'll go just deeper into the Bloomberg terminal, where they in real time measure expectations in the market of whether we'll see an interest rate cut. We have this Bank of Canada decision next week on Wednesday. We were at around 80+% expectations that we'd see a cut before this news. We're now north of 90%. Although when I look at Bay Street more broadly speaking, the economists, that is, they're a bit more mixed. Walk us through your thinking now. A possible cut next week, and then what happens in your view for the rest of the year?
Yeah, my view is just that it makes sense, given there's not really big signs that we have a pickup in inflation. It makes sense to continue the cutting. 50 basis points will provide a bit more marginal stimulus to the economy, so you can have a better view of how the system reacts to lower interest rates. But then you wait maybe until October or even December to see how the economy reacts, how businesses react to it, how the housing market reacts, how consumers react to those lower interest rates, and then from that point you get the data to make a better decision, and you get more also inflationary data to see, okay, is the system still on track to reach a 2% target? So then I'm thinking that December probably will be the next time for a cut.